Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow. All right, welcome to The Wealth Flow. My guest today is Yannik Cudjoe-Virgil. He is the principal of Merlin Acquisitions, a real estate investment and syndication fund. Merlin Acquisitions' primary focus is to provide risk-adjusted, value-add, and opportunistic real estate investment opportunities to professional athletes, business owners, and W-2 professionals. Yannik is the host of the Mogul Marathon Real Estate podcast as well. His experience in commercial real estate began as an asset manager by trade for both retail and institutionally capitalized real estate. But prior to that, he was a linebacker in the NFL and played for the Tennessee Titans before retiring in 2017. So, Yannik, welcome to the show.
Thank you so much for having me. I'm really excited.
Me too. This is going to be good. I can't wait to dig into your story a bit. And in doing that, if we could maybe just start from the beginning, man, where'd you grow up, and what first led you to the NFL? And maybe talk a little bit about that journey, because I know it had to have been, have its own trials and tribulations, and so yeah, any insight you can give us on that, and then we'll go to how you transitioned into real estate.
Yeah, absolutely. So my story really stems from my home country, which is Trinidad. And I came to the U.S. when I was about 10 years old. My mother and I came with just a suitcase full of clothes, and we really wanted to make it happen. She sold her house and really gave me the opportunity to come to the U.S. and quite frankly, live out my dreams. And so, fortunately, I stumbled into this sport of football, and I wasn't really that good when I started, but with hard work and dedication, I just, somehow got good enough to make it to the NFL. I, unfortunately, when I got to the NFL, my first year, I blew out my knee, and it was a situation where, I never would have thought that, for 15 years after, playing a sport, working day in, day out, blood, sweat, and tears, that unfortunately the career would be ended, so shortly. And, I tell people this all the time, athletes, it's no different from, a doctor, right? Who worked for 15 years to get to one spot. And, the next day, you were told that you can't be a doctor anymore, right? That's a shock to anyone.
For sure.
That's a shock to the system. And so, fortunately, I got introduced to a developer in Nashville when I was in Tennessee, and he introduced me to the world of commercial real estate. And I really got excited because, my first month in my first off season in the NFL, I spent like $20,000, and I had no idea what I spent it on, even till this day. And I really did not want to be a part of the statistic of, 70% of NFL athletes go broke within 2 to 3 years after leaving their sport. I wanted to make sure that I was able to use some of the money that I was able to earn while I was in the NFL and, put it to work, create a legacy, right? Create a lifestyle that I wanted to have for myself and the people that are coming after me. So fortunately, I got into real estate by way of just learning learning from the great minds in my backyard, which is the Washington D.C. area, working for different private equity firms, just picking up things as I went along within the asset management space. And, fortunately, I developed enough confidence and information and education to be a full-time real estate investor. So we've been full-time for about a year and a couple of months. And so it's just been a blast.
Yeah, that's interesting. And what about, first, congratulate you on just being able to make that kind of a shift. That would be devastating to most people. And a lot of folks would have just stopped there, right? And said, the luck, poor luck or whatever. And then, their life takes a different trajectory. And you instead have not only made the most of that. Did you do anything from a work standpoint between the NFL and, kind of getting into real estate and putting your money to work, or what did that look like?
No, I didn't. I figured that real estate was going to be my transition just by way of reading books like Rich Dad, Poor Dad.
Yeah.
And I found that real estate was a great opportunity for me to leverage the same skills that I've just cultivated from sports, whether it's being a leader, knowing how to, put people in certain situations, knowing how to handle adversity. I mean, that is literally the characteristic of real estate investing, right? If you're not willing to put people in the right places, if you don't know how to respond to adversity, you're really going to have a tough time doing, active real estate, right? You can be passive, that's one thing, but if you really want to be active, you have to be willing to handle adversity. So I felt it was a natural transition to leverage some of those skills to be successful in real estate.
Yeah, and with you had done asset management. Can you maybe talk a little bit about kind of what that is for somebody who isn't a lot of our listeners? They're W-2 professionals. They make a good earning, but they may not fully. They've heard of real estate, but they may not fully know. What all there is out there when it comes to that. So what does an asset manager do?
Yeah. So a lot of people don't know the difference between asset management and property management. So let's start with property management is essentially a service provider that you're hiring to be the first line of defense on the property, right? So they're the people that's on the ground, boots on the ground, essentially acting on behalf of the managers, the owners, or the asset managers, who essentially are the high level folks looking at things from a 30,000 square foot level, putting people in different places, and they're essentially acting on behalf of the owner to execute the business plan. So your asset manager is essentially your quarterback on the field, making sure that everyone is in the, in their right positions. And, they're the ones that's responsible for scoring the touchdown in this case.
There you go. So you went from linebacker to quarterback there. So awesome. And then, so was that the primary position that you held through and currently do, or what is your role now?
Yeah, so my role is essentially, a multitude of different functions, as a growing entrepreneur, growing company. But to first answer your question, so my role when I first started in real estate, working for different firms, I was primarily an asset manager. And the reason that I wanted to learn that is because that is essentially the most important aspect of real estate, right? Or commercial real estate is the execution part. You can acquire properties. That's great. You can, raise the capital. That's great. But after you close, that's really where the money starts, right? That's really where the meat and potatoes really start in terms of the execution side of things. And I think, Keith, better than anyone that, it's you can say you can do one thing when you first, set out to acquire a property, but after you've closed, you actually have to get the work done. And that's one of the things that I've found also when I was learning about commercial real estate. I saw that there was not a lot of education out there on like asset management. Everything out there was on acquisitions, raising capital, and that's great. But if you don't know how to operate, you're really not going to be successful in this business, right? Unless you have a partner that knows how to operate and you kind of leverage their systems, processes, company, expertise. So I found that asset management really helped me, think about things differently, really put infrastructure and systems into our business that allows us to scale, because that's one of the prime reasons why companies don't scale, is because they do not have it's because of the lack of infrastructure and systems. And Keith, probably better than anyone else as an entrepreneur, it's easy to be a solopreneur, right? You're the person that's doing the accounting when you start off, the property management maybe, or the construction management. So if you really want to scale and grow a large firm, you really have to know a lot about infrastructure, and asset management is one of the key functions. So that is essentially, that was essentially my role, and how it helped me get into, or translate that into what we're doing. So fast forward to our company. So my role is primarily on the front end, which is the capital raising and the acquisition side of things, and then also part construction management. So I have a partner that handles the front end on the day to day within the asset management construct. But for me, I enjoy talking to people. I enjoy getting on podcasts, sharing the message, connecting with people. And also sometimes I like to be in the field as well. So I've always felt that, you should, if you're going to do something that you love doing.
Yeah, for sure. And what markets are y'all focused on the acquisition side?
Yeah. So our primary focus right now is Baltimore City. Okay. We've acquired 3 deals in Baltimore City so far. And, we like Baltimore because I'm from Baltimore. I understand it. It's a very, block by block market. It's not as, it's not as pretty as a DC or New York, but there's a lot of cash flowing opportunities. And, our investors are primarily cash flow focused, not necessarily, levered towards the appreciation side of things. And we found Baltimore to be one of the best markets in the country because of the stable job sectors, right? We have what we call feds, eds, and meds, right? The federal government in our backyard, medical jobs and educational jobs, which tend to be one of the better jobs from a recession, resistance sector. So that's why we love Baltimore for real estate.
Yeah. So tell me a little bit about the type of properties that you're buying. Are these, what class are they? And, size wise, kind of what fits the buy box for y'all?
Yeah. So, we started off in the 20 to 30 unit space. Our last deal that we closed about a month ago was a 29 unit property located in Baltimore, Maryland. It's a C-class garden style property. And, we're at the phase where we're scaling up into larger opportunities. One of the things about, our 29 unit property was that I think that there are low hanging fruits that, operators really need to consider.
For sure.
So for example, what we done on this particular property is we performed an energy audit, right? And what that allowed us to do was to capitalize on low hanging fruit, because the entire property had one boiler system, right? So as you know, when things get hot, tenants open the windows and all of a sudden you have gas bills that are out the roof. Well, what we decided to do was we decided to install some valves on each individual radiator. So that's going to allow our tenants to really have some sort of individualized temperature setting to not exceed our master temperature for the entire building. And we found that that's a great opportunity to cut costs, drive NOI upwards, which, ultimately creates value on the property. And, we love these workforce housing properties because for this example right here, right, there are a lot of low hanging fruits that I think that people just, when they look at properties, they just look at income, expenses, maybe a water bill here. But I think in this competitive environment, you really have to dig a little bit deeper and find some of those additional revenue streams to drive NOI, which ultimately creates a better return for our investors.
Yeah, absolutely. And that's a great idea. I mean, utilities is usually one of the largest expenses. And so, just finding ways to be able to reduce that and cut that. What other opportunities are you looking for when you're looking to purchase something? Are you trying to find areas, in your bio, it talked about value add. And I know what value add is, but just, for the audience, what are you looking to do with that property as far as adding value?
Yeah. Yeah. So I think there's a lot of different things that we look for. I mentioned, the energy audit side of things. I think from our perspective, we try to really dive into things on a property by property sector, specific, acquisition criteria, if that makes sense. So, for us, we know that our competition is just looking at, income and expenses and maybe a water bill. But we really feel that, a lot of these vintage 1940s product or 1960s product, a lot of those products have, like some tax credits that can be utilized from the state to bring some of the older infrastructure up to code. Or maybe, your local utility company is offering, a lot of rebates to convert your gas water heaters into electric water heaters.
Right.
So that's really when I say that we dive into like specific, property by property value add streams, that's really what we kind of look for is what are the low hanging fruit opportunities that a lot of people don't know about, because they're simply not exposed to it. Or they're not researching about some of those low hanging fruit opportunities. How can we capitalize on that and be a little bit more competitive within our offers?
Yeah, makes sense. Tell me, I guess, a little bit about, if somebody decided they wanted to invest with your company, what kind of a buy-in or amount, and do they need to be accredited investors? What does that look like?
Yeah, so our investor base is, kind of a mix between retail or everyday investors, folks who are working a job, who have a business or, a professional athlete, that, maybe can invest $30,000 to $50,000 of free cash flow into, cash flow and opportunity. I think, one of the things obviously that I love about commercial real estate is the double bottom I, which is income and impact, right? Mm-hmm. Being able to increase income, leverage taxes through cost segregation, and also create an impact because we are, affordable housing investors, right? We're soon to be working on some tax credit opportunities, which is a totally different sector. But, our investors, we really let them know that, not only are you able to create create yield for yourself, but also an impact within the community as well. I think a lot of our investors, if you're someone who enjoys helping other people and benefiting the community, we should definitely connect offline for sure.
Yeah, that's one of the rewarding things about affordable housing, is just really you are making a huge difference. And whether it be taking that property, I mean, it improves the entire neighborhood when somebody comes in and completely, redoes a multifamily. I mean, it just is a facelift for the entire community. So, good stuff there. What about, as far as, the exit strategies? What are you typically buying and holding these for long periods of time, or what is the kind of the end game for an investor?
Yeah, I think so. Our business plans essentially wrap around a 3 to 5 year hold period.
Okay.
We would love to refinance at some point, maybe year 3 and cash out, return, 60 to 70% of principal back to our investors and maybe ride it out to year 7 or so. I think within this, this interest rate, this commercial real estate environment right now, how we're looking at deals is, we're focused on buying at the right price. We think that, this interest rate, space is somewhat temporary as relates to, maybe inflation, some of the monetary policy that the Fed is really trying to stabilize within the economy. And so we're really just focused on buying at the right price. And so our our theory is that our hypothesis is that, obviously if you buy right in real estate, then, when the market stabilizes, you should be able to exit at a good price, right?
For sure.
And so for us, we are focused on buying at the right price and not really taking on, huge, heavy value add opportunities in this cycle. We recognize that there's still a lot of uncertainty out there. We really don't know where things are going to be. We don't know about interest rates. We saw that, inflation is starting to tick down a little bit. But for us, we really want to have some sort of predictability of income at this point, right? So, and predictability of an exit as well, too, right? So, for us, it's about buying at the right price, making sure that our fundamentals are in line. And, once it's time to sell, then we should be able to exit out at, a competitive basis compared to the stabilized market.
Yeah, for sure. And quite honestly, if the deal makes sense now with today's rates, then it's only going to improve when the rates do come down a little bit, and you have that opportunity to do the refinance, pull out some of the equity, and return it to the investors. And just improves everything when you have the ability to lower the monthly payment. So you mentioned cost segregation, and you guys are utilizing that. Tell me a little bit about your tenants. You mentioned workforce housing. Do you do anything with like Section 8 government assistance type stuff, or what does that look like for you?
Yeah, definitely, man. I love talking about that because so I think there are two ways that I look at it from a tenant based perspective. Mm-hmm. One, I was just telling someone the other day, when a lot of people have this misconception that first and foremost when a recession is on the horizon or times of turbulence, you should be automatically be in Class C, properties. Mm-hmm. Well, I would disagree with that and just focus more so on the quality of your tenant base, right? Because if I'm investing in a Class A market that is oversaturated and there's a ton of product out there, then you're probably not going to do well in that particular market. Whereas if I was investing in a Class A, some sort of affordable type of property, that has low supply compared to what's out there, then you would probably do well in that particular market. So I say that to say, for the listeners out there, if you're getting into the world of multifamily, when it comes to property operations, you really want to focus on the quality of your tenant base, right? Yeah. And really shoot for occupancy. Occupancy is really what drives the pro forma forward. I think there's a lot of information that's being circulated that's quite frankly just bad information. But I think, once you really get into these properties and really get your hands on it, you really understand that it's about heads and beds. So to answer your question, specifically in the workforce housing space, if you are investing in, let's say you're in a 20 to 30 unit space, or you're buying a 15 or 20 or 30 unit, a couple of, vacant units can really tick down your occupancy. Sure. And impact your ability to pay your operating expenses or your mortgage, et cetera. So for us, what we do is we try to make sure, if the property allows it, we try to make sure that, we have some sort of balance between Section 8 vouchers and market rate tenants. Sure. And that allows us to really have some surety of income in the event that there is some sort of recession, in the event that, there's some hit on occupancy. We at least have some sort of quote unquote guaranteed rent that's coming in from the government. Sure. To make sure that we're meeting our obligations. So that's really how we look at, our tenants and just leasing up properties responsibly, because, at the end of the day, the worst feeling out there is having units that are just sitting vacant and not collecting income, right? And you have to distribute cash to your investors. So we really take that into consideration when we're leasing properties, and we want to make sure that our first and foremost priority is getting heads and beds, and that's above anything as it relates to the business plan and executing some sort of value add concept to get our returns for our investors.
Yeah, makes a whole lot of sense. And And you're right. The smaller the number of units, it has a huge, much bigger impact when you've got a few vacant spaces. So, what about with Baltimore? Did going through COVID, were there any eviction moratoriums or any rent control, anything out there that you face there in Baltimore?
Yeah, definitely. I think, Baltimore specifically had, I think it was one of the leading rent growth markets in the country. I think, we saw, rents that were up to, like 19 to 20%,
Oh, wow.
during COVID. And I think, a lot of that has trickled back down, right? Back down to reality. Because I think that, if you thought that rents were just going to increase 10% per year, that's a recipe for disaster. Baltimore, unfortunately, is one of the more tenant friendly markets. And it's a lot of, bureaucratic things that you really have to put up with to invest in Baltimore. So I would definitely recommend, before anyone invests in Baltimore, definitely learn more about how things are ran in Baltimore, because it can really impact your ability to be successful. But to answer your questions from an eviction moratorium perspective, yeah, you're going to have some of your what I call professional tenants, right? People
Right.
who are going to, take advantage of things and feel like they're smarter than you and can, delay their ability to pay rent. We did have a couple of those situations with those professional tenants, but I think across the board, if you're really leasing, properties with folks that are responsible, and you really kind of figure out who you're leasing the property to, I think you've done better than others in over the last 24 months.
Yeah, for sure. So how many multifamilies do you guys have in the Baltimore area?
Yeah, so we're currently operating 69 units across 3 properties.
Yeah, there you go. All right. And those were all like how long have you been acquiring them? That's over the last couple of years, or what does that look?
It's about over the last year and 3 months or so.
Okay.
Over the last year and 3 months. So, around the time when I first, went full time in real estate, that's when we, like a couple months prior to that was when we, first acquired our first acquisition. I tell people this all the time. It's really about the journey. It's not about, my goal is to create a sustainable, long-term firm.
Mm-hmm.
And it's not necessarily about jumping into a large property or doing something else that someone else is doing. It's more so about just running your own race at your own pace. And that's really what my podcast is all about. The Mogul Marathon and Real Estate Podcast is that it's a marathon, not a sprint.
That's right.
And if you really just focus on the journey, you focus on doing the little things, day in, day out, you might look up and you'll be, a billionaire at some
Right.
point.
Yeah, exactly.
So, that's really how we look at things, is that we don't want the fast, the overnight success type of story. We want the steady and the for sure type of story. So
Sure.
that's what we look forward to.
Okay, perfect. And so you think you're going to get into any other kind of property, or stick with multifamily as kind of, in the future here?
Yeah. So I think for us, our next progression, as I mentioned, was affordable housing tax credit opportunities. I think, we live in a time where, if you know how to solve an affordable housing issue, you can really make some good money in real estate at this time. We hear it all the time. Every it seems like every state across the U.S. is dealing with some affordable housing, crisis. And I think, tax credit opportunities really present an opportunity for private investors to really add value to the community, provide affordable housing. And I think there's opportunity to turn some of these existing products into tax credit affordable housing as well. So that is our next goal, and we're super excited to bring along some investors with us.
Yeah, I think that just builds in a lot of different value if once you know how to do it and what areas to buy when it comes to the tax credits. I mean, it's just, it's value add without having to actually do too much, to the property itself. So great. What about leverage and that it may have changed over the last several years, but how much loan to value are you putting on these? Kind of what's the strategy, and then if there's been any changes from an underwriting standpoint, over the last this year, obviously rates are higher. There's still, I think, a chasm between, what people think the property's worth and kind of the newly adjusted price based on the higher rates. But what are you seeing there?
Yeah, so I think for us, our leverage is still going to remain the same as long as we feel really good about where we're buying the property at.
Mm-hmm.
And I think there's a lot of articles and conversation out there about a lot of investors who took on floating rate debt, and there's this huge wall of maturities that are allegedly coming
Right.
to fruition in 2024 or over the next 12 months or so. For us, it's really about focusing on buying properties at the right price. I know I've said that a lot, and fixed rate debt is surely equally important as well, because we do want some predictability of returns. And we're okay with doing some sort of step down prepayment penalty and exiting out
Mm-hmm.
at a penalty that's factored into our exit hold period, right? So for us, it's kind of a mixture of buying properties at the right price, putting the right stable debt on it that gives us some predictability, and just providing a nice quality experience for our investors during this cycle, in the hopes that once those maturities come online, we'll be able to take advantage of those opportunities, and hopefully the Fed calms down a little bit on rates, and
Hopefully
we can
so.
really get after it with some profitable properties. So that's really how we look at things today.
Okay. And as far as the financing goes, what are you using local banks, or what lenders are kind of your go-to? And is it recourse debt, or what does that look like?
Yeah, so we've done both. We've done agency debt,
Okay.
and agency is kind of like a go-to in the multifamily space. But we've also leveraged some credit union opportunities or credit union debt that we were able to get some construction to perm finance within our loan, right? So we're able to do like 2 years, 3 years IO on the construction period, which helps us in our value add concept. Our business plan takes the stress off distributing cash flows while we have some volatility in the rent roll while we're turning the units, and allows us to really just roll into a permanent financing. And we found that on the deals that we've done with that, we found that to be very, very attractive, because typically with credit unions, they don't see large or larger multifamily opportunities, right? And some of those smaller banks, they feast for those types of loans, because quite frankly, that's likely what they want to do more of. So, we found that, bringing some of the smaller deals, or even the larger deals to a credit union, can be, really, really, really attractive from a debt perspective. Obviously, there's the recourse portion that, you should expect. You could always negotiate better with a credit union, investment, mortgage or investment committee, mortgage committee with your loan docs, as you would, compared to, or as opposed to like a Freddie Mac, which is pretty standard. There's no negotiating
Right.
with Freddie Mac. You can probably get the recourse provision maybe pulled down to a partial recourse or maybe non-recourse, right? So, definitely think about that, for your listeners as you're out there looking at multifamily opportunities, take some of those quotes to a credit union and see what you can get out of it. I think there might be some opportunities to get some favorable debt from there as well.
Yeah. Okay. And then you mentioned the construction and being able to kind of put some of that into the loan. So what when you're looking at some of the obviously project by project varies, but what's one that you've done some of the construction piece to it, and what was added was just updating, or what kind of construction did you do to add the value?
Yeah, so on our 22 unit deal, we were able to negotiate a 3 years interest only at about a 4%, fixed rate for the first 3 years,
Nice.
and that converted to a perm at 3.75. For I think it's 15-year term on the note.
Oh wow.
And so that type of structure, obviously that was pre interest rates going up, since last year, March or so, right? So that was a long time ago. So I think that opportunity really allowed us to focus on renovating the units. So far, we're about 50% or so turned on our value add program or business plan. And again, the interest rate, the interest only portion really helps you helps with the ease on your mortgage payment, because there are a lot of things that are going on within the value add business plan. Tenants are leaving, you're trying to iron your systems out. And there can be a little bit more volatility than you would expect. But certainly for all value add opportunities, I would obviously highly recommend that, interest only is somewhere within the first couple of years to really allow you to make, maybe some small, some, I don't want to say mistakes, but, have some small hiccups on your property,
Right.
Before you stabilize it.
Yeah, because even doing inspections and due diligence ahead of time, never fails, right? There's going to be some kind of a surprise or something that didn't go quite as planned. So not having to pay anything but the interest just leaves a little bit of breathing room to be able to do that effectively.
100%.
Yeah. And as far as property management goes, what does that look like with you guys? Are you using local property management? Do you use the same folks on every deal, or what? How do you have that structured?
Yeah. So we use local property management. The thing when you're transitioning from, or when you're doing, deals in the 30 unit space, for example, the issue that you tend to run into is that for the larger property management companies that are managing, 100 plus units, 200 units, 300 units, that have a full staff, all the systems, they're not going to pay attention to your small little 30 unit property.
Right. Yeah.
And then the issue is that, on a 30 unit property, you have, maybe smaller management companies who can't necessarily handle your 30 unit property because they don't have the infrastructure. So you're kind of stuck in between of finding someone or finding a company where you can give them enough business to focus all on you, or you just have your own vertically integrated property management shop. So, we chose finding a property management company that we can give them all of our business. And, we found that they're growing and they're eager to do more and build out their property management company. And we get them to focus all of their attention on our property. So it's a win-win for both. We bring more business, we get more attention. So, that's essentially how we operate on those properties.
Perfect. Okay. And as far as how people can find out maybe more about you, how they could invest, do you have anything that you're currently raising for, or how can people find out more about you?
Yeah, nothing at this time. I think the one of the best ways people can find out more about what we're doing is first by definitely subscribing to our podcast, the Mogul Marathon Real Estate Podcast. We have a ton of phenomenal guests on there. And then the second thing is just by going to our website. If you're looking for cash flowing opportunities, go to merlinacquisitions.com. That's MERLYNN acquisitions.com. click our investor form section, fill that out. Or if you're just interested in just learning more about how to vet operators, maybe you are just trying to figure out, what types of deals should I be looking for? How should I be looking at deals? Definitely go to our website and download our free syndication guide for passive investors. It's a wonderful guide for anyone who's just trying to learn more about how to get into real estate as well. So that's the best way, or one of the best ways that they can connect with us.
Okay, perfect. And just out of more curiosity on my end, as far as a 20 to 30 unit apartment complex, what is something like that in Baltimore? The type that you're buying and everything, what does that run cost wise?
Yeah, so I think a reasonable expectation would be around 90 to 120 per door.
Okay.
I think there has been a ton of competition or a ton of liquidity coming down from like New York, looking at opportunities in Baltimore, Maryland, because the price is much less, right? Compared to, expensive product in Baltimore. So there has been a lot of competition as of recently in Baltimore. So, just like anyone else, you kind of get squeezed when you're dealing with larger check sizes, right?
Sure,
So
yeah.
we are focused on looking at other opportunities down towards south of the country, down to the Sun Belt region, and finding some solid markets to deploy some capital in. So that's what you should expect in Baltimore.
Okay, no, that's perfect. And as far as when you're not doing real estate, Yannik, what do you enjoy doing outside? Do you have a family, or what does that look like?
That's a good question. That's a good question. I don't really get asked that too much because real estate pretty much is my life. I enjoy doing it. I work like 90 hours a week. I do have a fiance and a dog. But for me, it's really between real estate and just working out, right? Freeing my mind, just working on my mental health, because, the reality is, health is wealth, right?
Mm-hmm.
Sure. If you're not good in your mind, if you're not taking control of the 6 inches or the 8 inches between your 2 ears, that's something that you should really be focused on, right? Just for a healthy lifestyle. So if it's not real estate, I'm probably just working out, and that's pretty much it. Real estate and weights.
Okay. All right. There you go. Well, that's a good combination for sure. What about for somebody who maybe is just getting started? What any advice that you could offer them?
Yeah. That's a really good question. I would say the biggest advice that I would give is really to focus on your infrastructure as quickly as possible. I mentioned this earlier on in the podcast. When you first start off as an entrepreneur, everything is on you, right? You're the lead accountant. You're the construction person. You're the money guy. You're the one that has to come up with everything. And I think that, if you really want to scale in this business, you really have to, be willing to create systems and processes and hand those tasks off to someone else. Because, it took me a while to really realize, my time isn't well spent, picking up materials in Home Depot, for example, right, on a project. My time isn't, well spent, doing accounting for properties, right? And I think, a lot of times as entrepreneurs, we have this struggle with giving up control, because the reality is that nobody cares more about your business more than you. This is your baby. Your money is invested. Your life is probably intermingled with the business, and everything is on the line to make sure that the business is successful. But, if any one of your listeners, read the Robert Kiyosaki, book, he talks about the cash flow quadrant, right? And you start off as W-2 owner and a W-2 worker, and then you go to like a solopreneur, and then you kind of go, across the quadrant. And the goal is just to be an investor, right? Letting your money work for yourself. And if you're not able to, if you really want to achieve the freedom that real estate, people talk about, where it's just a lifestyle and you're just waking up and you're doing whatever that you want to do, you really have to, really focus on just building out that infrastructure so you can hand those tasks off to, people on your team and really just work yourself down that progression to just being the CEO, right? The visionary of the company. Essentially what I like to call just the money guy, right?
Right.
The guy that just writes checks and gives out orders. So, if there was one thing that I would want to tell, someone who's just getting started right now, is definitely focus on systems and processes, because, there's going to be some point of time when, if business does start to really run and start to roll down the hill, you're going to look up and it's going to be like, oh man, I'm so overwhelmed, So, that is something that I 100% recommend.
Yeah, I think that's great advice. It's kind of the who, not the how. And pretty well most investors at the beginning, it's just, okay, wait, how do I do this? And getting right into the middle of, everything from the property management to the repairs to, Lord knows what. And then, being able to just instead say, who on my team could I assign this to that will take it and run with it. And yes, you do lose a little bit of that control, like you mentioned, but ultimately, I think it takes you a lot further by looking at it from that approach as to how can I not do this, myself, and ensure that somebody else is handling it. So,
100%. You really have to know like where your $1,000 tasks are instead of your $15 or $20 per hour, because or she's just going to be a slave to your own business.
Yeah, for sure. And then what about you mentioned Rich Dad Poor Dad a couple times, but I always like to ask, and again, this is somewhat selfish for myself. I'm always looking for the next good book, but what is any book recommendations that you might have?
Yeah, definitely. One of my favorite books is The Power of Now by Eckhart Tolle.
Okay.
And with the concept of that book is basically about just living in the moment, right? Like sitting back and just reflecting and just taking a step to really, pat yourself on the back. I think for me as a former NFL player, former professional athlete, there is no good job like in my household, right? Yeah. You close this deal, like, okay, so what's next?
Right.
You know what I mean? I think that for me can be, or for anyone can be, an Achilles heel, because you're not able to really just appreciate the good work that you've done and really just focus on being in the moment, right? You're always just chasing for the next thing. And I think, that is the perseverance task, the never die attitude task. That is definitely one of the precursors for a high achiever. But I think, for anything, if you're great in one thing, you have to lack in something else, right? And I think in order for us to really achieve this high level of entrepreneurship, or at this nice balance, you really have to be willing to take a step back and really just sit in the moment and really just appreciate, like, I really just closed this deal, because 12 to 24 months ago or 5 years ago, you would have dreamt being in the position that you are today. Right. So it's just about just appreciating like where you are, or owning where you are, and really just living in the moment.
No, that's good. I haven't read that one, so I'll definitely have to check it out. And I think that's great advice. It does make a big difference. I mean, oftentimes, like you said, we're always just chasing something, and it's nice to be able to sit back for just a minute and say, "Gosh, have some humility and understand that you've come a long ways." So that's awesome.
Yeah. 100%. And just to add a little bit more, social media doesn't allow us to do that, and I think that's one of the reasons why, people are always, just judging themselves and comparing themselves to the person on the left and person on the right. But, it's just about, this game is a marathon. It's not a sprint, right? It's about just running your own race at your own pace.
Yeah, that's great. Great advice. All right. You've been full of all kinds of nuggets here. So, Yannik, I really appreciate you taking the time to visit with us, and have really enjoyed this. So thank you so much.
Absolutely. Thank you so much for having me on the show.
All right.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.